Sophisticated lenders and investors do not fund visions, they fund engines. Capital readiness connects the dots between your strategic intent and the technical reality of your unit economics. Most founders operate under the delusion that a compelling narrative compensates for structural insolvency. It does not. When capital raises fail, it is rarely about the product's features, it is about the physics of the business model. We observe a consistent pattern. Founders present aggressive growth projections while the underlying unit economics, specifically customer acquisition cost and lifetime value, are fundamentally broken. You cannot scale a defect. Today, we are dismantling the growth at all costs myth and replacing it with the technical frameworks required by institutional capital. We will examine the precise mechanics of CAC to LTV ratios, the often miscalculated payback periods, and how to transform your financial model from a static pitch artifact into a living operational engine. The first point of failure in capital markets is the CAC to LTV imbalance. This is not merely a metric, it is the heartbeat of solvency. Sophisticated investors evaluate readiness by determining whether you are spending $1 to generate 3 or spending $1 to generate 90 cents. The market is littered with startups that attempted to scale marketing operations before their unit economics were positive. You cannot make up for negative margins with volume. The institutional requirement for viability is typically a ratio of 1 to 3. For every dollar of fully loaded acquisition cost, the customer must generate $3 of lifetime value. But the definition of fully loaded is where most models collapse. Founders frequently calculate CAC based solely on direct ad spend. That is a methodology error. A robust calculation must include sales salaries, onboarding costs, and the marketing software stack. If your CAC is sterilized to look attractive, you are not fooling the underwriter. You are blinding yourself to operational reality. When we look at failed scaling attempts, we see businesses that accelerated spend while LTV remained static or declined due to churn. This creates a cash flow trough that deepens as you grow. Capital providers do not finance this deficit unless the path to positive unit economics is mathematically proven, not optimistically projected. Beyond the ratio, we must analyze the velocity of capital recovery, the CAC payback period. This is the precise duration required for a customer's net margin contribution to repay the cost of acquiring them. The critical error here lies in the margin calculation. We see models using overall gross margin rather than recurring gross margin. If you include one-time implementation fees or professional services in your recurring margin calculation, you artificially shorten the payback period. This distorts capital requirements. Sophisticated lenders strip out non-recurring revenue to isolate the health of the core subscription or recurring engine. Furthermore, averages deceive. A blended payback period of 12 months may hide the reality that your enterprise segment pays back in 6 months, while your SMB segment pays back in 24. If you raise capital to scale the SMB segment based on a blended average, you will run out of cash before those cohorts become profitable. This is why segmentation is non-negotiable. Your financial infrastructure must have the resolution to track these variances. If the payback period extends beyond 18 months for a startup under 10 million in ARR, you are effectively acting as a bank for your customers, financing their usage of your product. Equity investors look for capital efficiency, not capital intensity. This leads us to the final component, the financial model itself. For the amateur, the financial model is a static document built for a data room. For the professional, the model is a living engine. It serves as the central nervous system of the organization. Sophisticated lenders and investors evaluate readiness through 4 interconnected pillars: methodology, integration, operations, and controls. Methodology ensures your logic holds under stress. Integration connects your accounting system to your forecast. Operations dictates that the model drives hiring and spending decisions. Controls provide variance analysis to see where reality deviates from the plan. A static model built solely for fundraising is a red flag. It indicates management does not use data to drive decision-making. Investors want to see a dynamic tool that answers what-if scenarios instantly. What happens to cash flow if churn increases by 2%? What is the impact on burn rate if the sales cycle extends by 30 days? If your model cannot answer these questions immediately, you do not have financial infrastructure. You have a spreadsheet. When you approach the capital markets, you are not asking for charity. You are presenting a machine that processes capital into returns. If you cannot demonstrate the mechanics of that machine through rigorous modeling and verified unit economics, the answer will always be no. Capital readiness is not about optimism. It is about precision. It requires a transition from founder-led intuition to data-led executive execution. If you are preparing for a capital raise and need to determine whether your unit economics will withstand institutional diligence, you must evaluate your pillars: methodology, integration, operations, and controls. Do not build a deck, build the engine. If you are preparing for a capital raise and want to know, before the market tells you no, whether your unit economics and financial infrastructure are truly institution-ready, Equus Capital Finance can help. Request a capital readiness assessment today. Stop pitching narratives. Start building engines.